Hello, everyone. Thanks for joining our workshop today. But before our session begins, I would like to invite our Senior Manager Strategic Partnerships, Karandeep Sodi, to give a quick overview of the company. Karandeep, over to you.
Natalia, thank you so much for the opportunity to have me introduce Kiwi Tech for our esteemed founders. And Will, thank you so much for joining us, and Josh as well. Okay, everyone. Well, thank you so much for joining our entrepreneurship workshop, 808 workshop today. So I'll begin with Kiwi Tech's introduction. So Kiwi Tech is actually an ecosystem, or rather a global community of innovators, investors, mentors, enterprises, and corporate communities. Today, we are an ecosystem of more than 500 portfolio organizations. Over the past decade, we've managed to build an investor network of more than 3,000 investors. A majority of them are angel investors, but we do have a lot of VCs and family offices as a part of the network as well. We've helped raise about more than close to 125 million US dollars. And we also have more than 200 mentors in our ecosystem to help support with the challenges that a lot of early stage and growth stage founders face. Now, a majority of them are from the investor network, but there are a lot of successful founders in the industries as well as a part of the mentor network. We've also invested more than 100 million US dollars in terms of tech services as an investment in exchange for equity for a lot of partnering founders. And all of this comes together with the events that we host. We host around 100 events on an annual basis, which averages about 2 to 3 events on a weekly basis. Now, if I talk about the roadmap, before Kiwi Tech, the founders of Kiwi Tech had already scaled a content technology company and had a pretty successful exit of 144 million US dollars in 2012. In 2013, we launched our Kiwi Tech startup program. Over the years, we did understand the challenges that a lot of founders were facing in terms of raising capital. So we launched our Kiwi Tech demo days. By that time, we were already an ecosystem of more than 100 portfolio companies. Now, in 2019 is when we launched our Startup 808 series, the Entrepreneur Workshop, and also expanded into the Middle East region. Today, we have our entities and offices in Qatar, and also we are operational in Riyadh as well. Now, in the past 2 years, a lot has changed. We've become an ecosystem of more than 500 organizations, as I mentioned. We host around close to 100 events annually, and we also acquired a New York-based organization, Graphite Financial, and we launched our go-to-market and crowdfunding services, along with 3 acquisitions that are already in pipeline. Now, we are targeting at least 100 portfolio companies to exit at a minimum 100 million US dollars, and we are already on track on becoming an ecosystem of more than 1,000 portfolio companies by 2024. These are our capabilities in Kiwi Tech ecosystem. We do provide technology services as a service, and we have more than 500 engineers as a part of the team who are all in-house. We've built about more than 1,500 products, and we also provide technical due diligence for finance and accounting. As I mentioned, Graphite Financial spearheads that division. We also provide events as a service. For external events, we provide startup pitch events, workshops, innovation hackathons, investor summits, and conferences. We also have an in-house marketing team to help you with your go-to-market strategies. So that we do have the digital marketing support in terms of SEO, SEM, SMM. And for crowdfunding, we've also partnered with vFunder and Start Engine to provide you with that extra benefit in terms of strategizing your crowdfunding campaigns. Now, as I mentioned, all of this comes together with the variety of events that we host. We try to maintain the relevancy for the investors and the founders within the ecosystem. And we try to do that by categorizing these events into, say, community-specific events where we host a lot of events for underrepresented founders. And we also host industry-specific events, be it region-specific or the stage of your business. We've also hosted our marquee events like Arena 24, which was a 24-hour pitch event, one of the biggest that the world has seen. We also hosted our Qatar's first ever e-commerce hackathon as an external event as well. So we're really looking forward to, we're very excited to have you just be a part of our today's, 808 series workshop, the Entrepreneur Workshop, and really thank Paul, Josh, and Will to, put their insights out. So thank you so much.
Awesome. Thanks for having us on. I think there may be some permission for turning the videos on our side if you all could enable that quickly. But thanks so much for having us on today. We'll do kind of quick introductions on our side. Here we go. Okay, got to start the video. Okay, there we are. There I am. Well, thanks so much for having us on. I'm Will Buckstaff. I've been at Carta for about 2 years, just over 2 years now, and I work on our partnerships team. So I work really closely with our law firm, VC, accelerator, founder group, ecosystem community players across the US. And so while I'm not out like raising a $10 million round right now or anything like that, I work with a lot of people who are really adjacently and closely involved with these financings, with early stage compensation, with things on that front. So I'm very excited to get into it today. I'll kick it over to Josh. Josh has a little bit of a different background than I do, but we're both really excited to get into this session today.
Yeah, there we go. Thanks. I'm Josh. It's nice to meet everybody. I've been at Carta for about 3 years. I'm on our marketing team over here, and I head up multimedia and education efforts. So just like Will, while I haven't founded a company myself, what I do is work with a lot of founders, especially like at the early stage of their fundraising life, to just help them kind of like surf the weird rat's nest that is understanding how equity works and understanding like how fundraising works. What we're going to do in this session is just run through a lot of the basics, like some of the equity 101 stuff that a lot of early stage founders don't have, like just this foundational level knowledge, because there's so much fancy finance language that's involved with fundraising and managing equity. So part of what we're going to do here today is just demystify all that stuff, break it down in very simple terms that are easy to understand, so that you have a nice foundation of knowledge for managing your equity in the future.
Awesome. Thanks for that. I'm going to share my screen quickly here. And I'd love to, so what I'm going to get into is kind of just a little bit of highlight on Carta, like why we're in the room, why we're even talking to you all, like why it makes sense for Carta to be here. And then Josh has got a great session of kind of like soup to nuts equity for early stage founders, just general terms that are good to know when you're raising capital or when you're thinking about compensating folks internally, and just how to think about it from a tax perspective, from a legal perspective. So I'm going to share my screen quickly here, and I'm just going to go through a couple slides just to kind of touch quickly on kind of what Carta is, what we do. First off, this is an important thing to note, is that we do not practice law in any capacity. Carta is a platform for companies who manage their equity. And so first thing we got to say right out the gate is that this is not legal advice. And so I think it's actually, if you can double down on this slide in the sense that we really recommend that you do work with a legal practitioner, have legal advice when you are going through these early stage journeys, whether it's raising money, compensating employees, figuring out the structure of your company. It's one of the best things that you can do to yourself to set up the trajectory for your ownership. You'll just give yourself the best swing at getting everything correct, so that maybe when you raise a seed round or a Series A round or whatever it is down the road, you have everything set up correctly. So you don't have to go back and then pay a bunch of billable hours to fix things. You can set them up correctly the first time. So this is not legal advice, but it's definitely, it'll definitely be good, good presentation on also why it's good to have legal advice too, because there's definitely some stories about folks who try to do things too much on their own at the beginning. But where does Carta sit in the market right now? Why are we here? Why does it make sense for us to be talking about this? So Carta, at the highest level, just started as a company that was digitizing stock certificates in the early 2010s. Right, we were removing paper from that equation. That was a really big pain point. It was one of the stickiest things that paper stuck around in, was stock certificates, because there's so much legal language and regulation behind it. So Carta started out doing that, and then we've evolved into a full cap table, so ownership structure management suite for companies. And so we have about half of VC-backed companies on the platform now. It comes out to be about 30,000 total private companies we work with. So today we're going to talk a little bit more on what focuses on the company side, but to give you the full 10,000 foot view, Carta works with companies for ownership structure management, the cap table side of things. I'll hone in on what that means in a second. We do compensation management for companies too. And then for investors, we do the fund administration side of things. So fund management, fund administration, capital call lines. And we tie those two together with our liquidity arm, which is called Carta X. And so that's secondary block trades, tender offers, anything private market liquidity. So that's Carta at kind of a glance. Carta specifically, and kind of the ownership structure management software that Carta provides means like a couple things. If you utilize Carta or one of these cap table management softwares, and when we say cap table, we're meaning ownership structure of the company. It's kind of the investable story of the company. It's any individual line item of ownership inside of the entity, and so that's what Carta helps manage. The whole idea is that you can reconcile your ownership in one place, you can transact on the platform, and then you can do the valuation. So the 409A, I know Josh is going to get into that and what that specifically means. But the cap table management, 409A, you issue out the securities through Carta. That's where we sit in the market. So we're kind of in the middle of these fundraising rounds that are going on. I think about half of VC money is raised through Carta. And so we have this view of all the early stage companies that are raising money, all the law firms that are working with their clients on the platform, the VCs that are seeing these portfolio companies raising and sharing data with them and all of that. So we kind of have that front row view to all of this. And so we've aggregated different data that we're going to share with you later on the compensation side of things, fundraising, where it's at in the market right now. So I'll jump in, share a little bit of that later. We actually have kind of an assignment for you all that we'll leave you with today. And then in the meantime, I'd love to kick it over to Josh to go into really the high level equity 101. Yeah, Josh, I'll let you take it from here, and I'll stop my screen share too.
Thanks, Will. And my ask for you, Will, is I'm going to be trying to keep an eye on the chat, but if you could keep an eye on it for me, just interrupt me. If anybody has questions, just like
perfect.
Out. And what I will say to this group here is that the session that I'm about to run, we're gonna kind of do a funnel thing. So I'm gonna start out with really high level stuff. We're gonna talk about fundraising stuff, and then as we kind of like, some of those high level things you may have heard of in the past, and as we kind of go deeper, we're gonna get more detailed into things like how taxes work, how vesting structures work, etc. So we'll kind of lay the foundation with some higher level stuff that you might have heard before, and then we'll go a little bit deeper into like the little nitty gritty details that a lot of founders don't know. My big ask of everyone on this chat is that this lesson is way better the more interactive you are with it. So please do not hesitate. This is totally a space to ask questions that you might think are dumb in another room. Whatever it is, float it out. We love to see questions come in so that we can answer what's actually relevant to you in real time. And so the first question that I'll ask to this group is, if you want to, in the chat, just throw out kind of like where you are in the fundraising process. Like, have you raised money yet? Are you preparing to raise money? Do you know what kind of instrument you're going to use to raise money? I.e., do you know if you're going to raise via a priced round or a convertible instrument like a convertible note or a safe? If you are at any point in the process, or if you're just like here to like learn a little bit about this stuff, throw it in the chat so that we can see what's relevant to you. I'll start out by just kind of like talking at you for a second. We're going to run through high level fundraising stuff. So the very first thing that I always like to lay out for people is fundraising is what every founder is concerned with at the very beginning. You're always thinking about like, how can I raise money? What a lot of founders tend to get confused on and feel a little fuzzy on is the types of fundraising that you can do. Jessica, I just saw your comment in the Q&A. Awesome. So you're currently raising your seed round using common stock, which is awesome. So when you're at that early stage and you're raising money, there are a couple of different ways that you can do it. And I think the basic way that a lot of people think about it is a thing called a priced round. A priced round is essentially what you see on the show Shark Tank, if anybody's seen Shark Tank, right? So, Mark Cuban comes in and says, I will give you $1 million in exchange for 10% of your company. And the reason why this type of fundraise is called a priced round is because in that moment, Mark Cuban is actually putting a price on your company. Mark Cuban is saying, I'm going to give you $1 million in exchange for 10%. So that must mean my 1 million is worth 10% of the total company, which must mean that the total company is worth $10 million. So in this kind of transaction, it's very straightforward, super one-to-one. The investor is putting a price on your company by offering you the money. But in Jessica's case, or in the cases of many of the folks on this call, you might be a little early for that kind of thing, right? Like you might be at a stage where you're still developing your product, or you don't totally have like revenue yet, or, depending on the stage you're at, you might be at a place where you actually don't have enough information to actually know how much your company is worth. And so in that case, founders tend to raise on a different kind of instrument, which you might have heard of, which is called, usually it's either like a convertible note or a SAFE instrument. And both convertible notes and safes they're kind of like two different flavors of the same candy, right? Like essentially what they are is an IOU. Mark Cuban, as an investor, says, hey, I want to invest $1 million in your company. And you say, well, that's great. I'm always happy to take your money, but I don't know how much my company is actually worth yet. And so because of that, I'm going to take your money today and I'm just going to kind of hand you an IOU. And I'm going to promise you that 12 months from now or 18 months from now, I'm going to have a way better idea of how much money my company is worth in the future. So 12 months from now, I'm going to put a valuation on my company. And when I do that, I'm then going to convert your $1 million investment into shares of the company now that I actually know how much the company is worth. That's why it's called a convertible instrument, is because the investor is giving you money today, and at a future point in time, you're going to convert their money into actual shares of the company. There are a million reasons why it makes sense to do this, but I'll pause here for 2 seconds and just check the chat. Does anybody have any questions? Are you like confused about how a convertible structure works? If not, I'll just keep cranking along. Will, do we have any questions in the chat?
Good to go for now.
Okay, we're all good. Okay, so next up, now that we kind of understand how different fundraising instruments work, let's start talking about price rounds. And this is the point at which I'm going to share my screen here. If anybody can't see my screen, just put it in the chat. So when you raise money, a lot of the time, the process of raising money can just get really hairy, and the lawyers are having to do a lot of work to make sure that you're protected from having your ownership be diluted too much, right? So one of the things that we've realized, like at the early stage, a lot of founders actually don't realize that, basically when you raise money, sorry. Oh, hang tight, my Photoshop's being weird. When you actually raise money, I think a lot of founders that we've talked to have this sense that like dilution means that you're losing a certain amount of your shares or something like that in the company. That's not quite right. So I'm going to draw some like basic stuff on the screen. I'm just going to draw a picture of a house. Let's say that this house is your company. And let's say, just for the sake of ease of numbers, today your company has 8 million shares in total. And you are the only person involved in the company right now. So you, as the founder, own all 8 million shares of the company, right? Well, then an investor is going to come in, like Mark Cuban's going to come in and say, all right, Josh, I'd like to give you $2 million in exchange for 20% of your company. So let's say Mark Cuban wants to take an even 20% of the company. What's going to happen at that point? You're going to accept Mark Cuban's money, and let's put you over here. So this is you. You are going to keep your 8 million shares. That never changes. But then the company is actually going to create an additional 2 million shares. These 2 million shares are going to get created out of thin air, And those 2 million shares are going to be given to Mark, the investor. Now, in total, the company has 10 million shares available. You still own the 8 million shares that you originally had, and Mark Cuban owns the other 2 million shares. So this is how dilution works. Before, when the company only had 8 million shares, you owned 100% of the company because you owned all 8 million of those shares. But now the company has 10 million shares. You still own the same amount, but now you only own 80% of the company, and Mark Cuban owns the other 20. And that's how dilution works. So any questions about dilution? Will, I'll have you check the chat for me before I move on to pre and post money valuations.
Chat's looking good.
Okay, awesome. So we're going to keep rocking through this. So now let's say that, sorry, I'm erasing all of my stuff here. So now let's talk about pre versus post money valuations. This might be a term that you've heard thrown around a lot. Basically, the idea behind pre and post money valuations is that your company, I should have just left that house up there, shouldn't I? Your company today is worth a certain amount of money. And when you engage with Mark Cuban, when you engage with that investor, Mark Cuban is going to assign a value to your company, or rather you and him are going to agree together on a value for your company. So there are a couple of different values that get placed on your company in the process of raising funds. If anybody doesn't know what a valuation is just the amount of money that your company is stated to be worth. And in the fundraising process, you're typically going to have a pre-money valuation and a post-money valuation. So it's kind of exactly what it sounds like. The pre-money valuation is what your company is worth before Mark Cuban gives you the money. And then the post-money valuation is what the company is worth after Mark Cuban gives you the money. So let's say your company is worth $8 million today. Your pre-money valuation is going to be $8 million. Then Mark Cuban is going to inject $2 million into your company, and your post-money valuation will be $10 million. So the three stages here to pay attention are there's the pre-money stage, then there's the actual investment, and then there's the post-money stage. And your valuation is going to be different in the pre-money than it typically is in the post-money. Now, the reason that this matters for you as a founder is because it's always a concern in your head that you don't want to lose control of your company, right? You always want to make sure that you're maintaining a healthy ownership stake in your company so that you don't accidentally raise money from a few investors and then realize at the end of that raise, like, oh no, I only own 3% of my company and I accidentally gave it all away without knowing what I was doing. So this is one of the major points where that happens to a lot of founders. And it's the reason why we really recommend engaging with a law firm when you're doing a fundraise. Does anybody not know what an option pool is? I'll have Will check the chat here. Is anybody raising their hand you don't know what an option pool is? Okay, cool. So if we all know what an option pool is, to review really quick, it's just a chunk of the company that you're setting aside for employees of the company that you're going to hire, right? So, oh, sorry, Jessica, I'm seeing your question here. What percentage are most founders of total ownership after the seed round do people aim for? Jessica, that's a great question. Will, I'll have us flag it so that we can look at the data after this presentation and start answering some of those questions.
Yep, you got great resources for that. That will be coming up after this.
Yep, Jessica, to pre-answer your question, Carta has a ton of data on this stuff that you actually have free access to as a founder. So we'll tell you where to access those resources in just a bit. So the option pool is this chunk of money that you're setting aside for employees of the company that you're going to hire and advisors and C-suite executives and stuff like that. You're taking a percentage of your company and you're just setting it aside to give to those employees once you hire them. a lot of the time when you raise money, there will be legal language in the contract where the investor is essentially asking you to carve out that chunk of your company. So let's say this chunk right here is the option pool. The investor is going to ask you to carve out that chunk at the pre-money stage. The reason why this matters for you is because, if you think about it, you can carve out the option pool from your company. Let's say you have a 10% option pool. You can carve out 10% of your company before the investor comes in, or you can carve out 10% of your company after the investor comes in. And it makes sense that the investor will typically want you to carve out that portion of your company for employees before they put their money into the company. So they want you to do it at the pre-money stage. But the important thing for you to know as a founder is that that option pool, the size of that option pool, whether it's 10% of the company or 5% of the company, et cetera, that's actually a really important negotiating lever for you as the founder and for the investor. The investor wants you to carve it out of the company before they make their investment, because that option pool is now going to dilute you directly as a founder. And the investor is not going to be diluted by that option pool getting carved out. It's an important thing to consider, because when you think about the size of that option pool, typically you want to, the traditional thing that people usually want to do is make sure that they have a really good handle on their hiring plan for the next 12 months or their hiring plan for the next 18 months. Because if you have a really good sense of how many people you're planning to hire and how much equity you're planning to give them over the next 12 to 18 months, then when the investor comes in and says, hey, we want you to carve out an option pool of 25% of your company, you actually have space to negotiate on that point. You can say, well, I actually don't need to carve out 25% because I know exactly how many people I'm going to hire for the next 12 months. And I know exactly how much equity I'm planning to give away. So actually, I only need to carve out a 12% option pool. So that's the first big piece that a lot of founders tend to rely on their legal team for. And it's important to kind of have the foundational knowledge in your head so that you know what you're negotiating when you're negotiating that option pool. I'll pause right here. Do we have any new questions coming into the chat, Will, or are we all good?
Good to go.
Okay, sweet. So next up, we're going to move on to vesting schedules. So let's go ahead and erase all of this stuff. And we'll start new with vesting schedules. So a lot of the time as a founder, you will be asked to vest your shares over a certain period of time. You'll ask when you hire employees, you'll set them on a vesting schedule in a similar way. Like a surprising number of people actually think like, okay, well, a company hires me. They give me 1% of the company. And the day I start at the company, wow, congratulations, here's your 1% of the company all in one lump sum the day you start. That is not the case. What most companies use is a thing called a vesting schedule, which is essentially the process by which you are going to earn your percentage of the company over a period of time. So the other way to think about that is the company is going to grant you, let's say, 4,000 shares of the company. Over 4 years, you're going to earn those 1,000 shares. So you're going to earn essentially 1,000 shares a year. And so I'm going to draw an axis here. We're just going to look very quickly at how a vesting schedule works. There are a couple of pieces of terminology that a lot of people aren't familiar with when it comes to vesting schedules. And the first is called a cliff. So if you've ever heard of a thing like, you may be anecdotally in conversations with people and you hear about a vesting structure that is like, these shares are going to vest over 4 years. So it's going to be a 4-year vest, and we're going to have a 1-year cliff. A lot of people don't actually understand what that term cliff means. So let's talk about the cliff really quick. So that cliff is, we'll say, just pretend on the horizontal axis, that is time. And then on the vertical axis, that's the number of shares that you actually have. So I'll just put time right down here. Forgive my horrible handwriting here. So time is on the horizontal axis and the number of shares that you have is on the vertical axis. The way a cliff works is, let's say it's a 1-year cliff. So this dotted line right here represents 1 year into your journey with the company. For the first year of your work with the company, you're not going to be granted any shares of the company. You're going to have 0 shares. And then right at 1 year, you're going to vest 1/4 of all of your shares of the company. So again, just for even numbers, let's say you were granted 4,000 shares. You were granted 4,000 shares. At that 1-year cliff, you're immediately going to vest 1,000 of those shares. So right here at 1 year, boom, congratulations. You have now vested 1,000 shares of the company. And I'm going to stop sharing my screen here really quick. I actually don't know how to stop sharing my screen. This is super weird. Anyway, I won't stop sharing my screen. But another important thing to realize is that being granted these shares, if they are a thing called stock options, being granted those options does not mean that you own your shares. Being granted those options means that you have the right to purchase those shares now. So there's another thing that a lot of people actually don't know from day one is when you're granted options in the company, for a lot of you, when you hire employees, you're going to grant them stock options. When they hit their 1-year cliff, you're going to immediately vest 1,000 of their shares, or you're going to vest 1/4 of their shares if it's a 4-year vesting period. But you're not actually giving them their shares yet. They still actually have to pay you money for those shares, and then you give them the shares. So I'll share my screen again here. The big question then becomes okay, well, what if the value of the company is growing over time, right? I was granted my shares at $1 a share, but by the time I vested, 1,000 shares, the price of the shares actually went, let's say you had a killer year. The price of the shares actually went up to $5. When I buy my shares, am I now paying $5 per share for those shares? And the answer is no. When you're granted the shares, you're going to be given what's called a strike price or an exercise price. And that exercise price is $1, and it's fixed forever for the life of that one grant that you've been given. So when you vest 1/4 of your shares at the cliff, you're going to pay $1 a share to buy your shares. And this is where a very important tax implication comes in that very few people are aware of, but it's very important to be aware of it. So let's say you were granted your options at $1. 1 year goes by, and congratulations, you've hit your 1-year cliff, and you now vest 1/4 of your shares. So you receive those shares and you decide to buy them. Now, remember, we have 4,000 shares in total. So you vested 1,000 shares right here. And we'll do some dummy math here. You vested 1,000 shares at $1 a share. So in order to buy those 1,000 shares, you're going to pay $1,000. But it's important to note that in that time, in the time between your grant and when you actually purchased or exercised your shares, the price of those shares actually went up to $5. And this is a really important thing to note because on paper, you have just made a profit of $4 a share. And this is the thing that a lot of people don't know, is that when you exercise your shares, when you purchase your shares, on paper, you have just made $4 a share. And you are going to be taxed on that $4. It doesn't matter. Like, I think the thing that confuses a lot of people is they're like, well, I didn't do anything. I just bought the shares, right? I didn't actually sell them. So wouldn't I just get taxed when I sell the shares? It kind of depends on the kind of options that you're being granted, but largely, especially if you're working with the most common type of options, which is incentive stock options, the answer is no. You're going to get taxed right here when you you're going to get taxed right here when you exercise or purchase your shares. And so it's very important for you to understand how to plan for this growth in between when you're granted your shares and when you exercise them. We always recommend working with a financial advisor. There's a lot of strategy that goes into trying to limit your tax burden when you exercise. But yeah, high level, the big thing to know is that at a certain point, you're going to be granted a bunch of shares and you're going to purchase them. If the price of the shares when you purchase is greater than the strike price you were given at your grant, then this delta right here means taxes for you. There are ways to avoid this. And as a founder, there are a couple of things that we see a lot of companies do. Namely, the big one that we see is called early exercising. So let me go ahead and just put these numbers back on the screen. Early exercising is exactly what it sounds like. So let's say you're an employee of a startup and you are granted 4,000 shares at $1 a share. So at the end of 4 years, you're going to receive 4,000 shares in total. You make it all the way to a year and hit your cliff. Okay, so now you vest 1,000 of those 4,000 shares. By that time, the strike price of the company has gone up to $5. And so this delta means taxes for you, unless your company just let you purchase or exercise all your shares right here. And that's called an early exercise. We do early exercises here at Carta for all of our employees, which essentially means like, hey, congratulations. Today, we are granting you 4,000 shares of the company. You're going to vest them over the course of 4 years. But as a favor to you, we're going to let you purchase all of the shares today. And then as you vest over the next 4 years, we're going to give the shares to you that you already bought on day one. This is a real cool thing. The question that we get most often is, why would you want to do this? Like, if you're an employee of the company, why would you want to buy all of your shares on day one? And the reason is because you're limiting that tax burden. Your company is doing you a solid and helping you limit this tax burden. If you're granted all your shares at $1 and you exercise all of your shares when the share price is still $1, then that means this delta right here is 0, which means that you are getting taxed nothing for purchasing all of those options. Now, again, you're still not going to be given the shares. You have to work at the company for 1 year. Then you'll be granted, your first grant at the cliff. And then you'll still vest the rest of the shares over 4 years. But the important thing is that you bought them. You bought all of them on day one, meaning your tax liability when you bought them was minimized as much as humanly possible. So at Carta, we allow for early exercises. It's a nice thing that a lot of companies do for their employees, but it also comes with a couple of complications. So if you early exercise, or if you offer an early exercise to your employees when you hire them, it's extremely important that you have them fill out a thing called an 83B election. This is a fancy word that literally just means a piece of paper. It's just a form that you have to fill out and send to the government. And what the form says is, hey, I have just early exercised 4,000 shares of this company. I've just early exercised 4,000 options. You have 30 days to tell the government that you have early exercised, or you'll get hit with a higher tax burden in the future. So the big thing to remind your employees when you hire them, or if you are an employee, or if you're early exercising at your company, if you're going to early exercise, make sure that you find Form 83B. If you're on Carta, Carta will just give it to you automatically. And you have to fill out Form 83B and notify the government, hey, I am early exercising all of my shares today. So make sure that you tax me at 0 today. Has to be done within 30 days or it doesn't count. I'll pause there for any questions in the chat. Will, do we have any new questions coming in?
Looks like no new questions for now.
Okay, awesome. So another big question that we get from—
I think we got another one from Jessica here, actually. Just, do most companies only give options? I think this is actually one we're going to look at later, but Josh, if you kind of have context on this now and like the different types of equity at the early stage, like options, RSAs, RSUs, like that type of thing.
Yeah, Jessica, there's, man, there's a ton of nuance to this question. High level, the answer is yes. Most companies that we work with give stock options to their employees. But I won't go into like all of the nitty-gritty details here, but there are different kinds of stock options that you can give people based on, if your company is a C Corp or an S Corp, essentially based on the structure of how you've set up your company, you can give people different kinds of options or different kinds of shares. Will, correct me if I'm wrong, but a lot of the time when a company is an LLC, we'll see them not give options, we'll see them give a different kind of share called a restricted stock unit. Mm-hmm. And all of these different kinds of shares that you can give to your employees affect your employees in a different way when it comes to taxes and actually purchasing their shares, et cetera. So what we will refer you to at the end of this is a thing that we have at Carta called Equity 101. And Equity 101 is literally just a video course that we have built. It's 10 lessons long. Each lesson is like 3 to 5 minutes or something like that. And one of the lessons actually goes through the difference between the different types of shares that you can give to your employees. So we'll give you the URL to take a look at the Equity 101 course when you're done with this. The high level thing to know, it's totally free and available. You don't have to sign up for anything. It's just online for you to look at and share with your employees as they need it. Does that sound cool? And Will, maybe we can go over some of the data behind Jessica's question when we're done with this.
Yeah, most definitely.
Okay, awesome. Jessica, I hope that was a good enough setup, and we'll look at some data after this. So next, one of the big questions that we get from people who are kind of new to this stuff is like, all right, well, my company isn't a public company, right? So like, sure, the price of my shares and like the value of my company, it is going up over time, but like, what is causing it to do that? It's not like we're on the public stock market where like, demand is controlling the price that a share sells for. That's a really good question. And the answer is that once you start raising money, you'll have to do a thing called a 409A valuation. You'll probably see this come up a ton as you continue through your founder journey. 409A valuation, the way we like to describe it to people is it's kind of like just getting the registration done on your car. It's in order to stay compliant with the government, you'll have to do this every 12 months or whenever you have some kind of material event happen, like a fundraise. So Jessica, in the case of your seed round, talk to your lawyer, but most often when you raise money, that counts as a material event. And what that means is that now you have to go to you have to report to the government, hey, I have had a transaction, and here is the official statement of how much my company is worth and how much one share of my company is worth. A 409A valuation is just a thing that you can get from a company. Like, I'll do a little shameless Carta plug. We are the biggest provider of 409A valuations in the United States. When you're on Carta, you basically just go into your Carta platform and you click a button and request a 409A valuation. And our team internally will work with you to get your 409A valuation done and filed. The reason why a 409A valuation exists is maybe everybody remembers a company called Enron in the early 2000s. I am drastically simplifying what Enron did, but it's like, this is a huge oversimplification, but essentially Enron falsely stated their share price. So Enron said that shares of their company were worth one thing when the shares of their company were actually not worth that, right? So after Enron happened, the government stepped in and created a rule called Section 409A. And what Section 409A says is that, like, look, too many people lie about their share price or base it on iffy information, right? So if you want to be compliant with the IRS, then you have to have a third party come in, look at your business and say, here is how much one share of the company is worth. So the rules around 409A valuations are you have to get them done every 12 months or whenever you have a material event like a fundraise. And the reason this affects you is because over time, that 409A valuation is what's going to cause your share price to go up. So to wrap it all up, over time, you're going to be granted shares at $1. Then you're going to wait, let's say 1 year, and then you're going to hit your 1 year cliff. And at the 1 year cliff, you're going to vest 1/4 of all your shares. You're going to vest 1,000 of those shares right there. This delta is what you're going to pay taxes on. And this delta is determined by the share price right here, which is determined by a 409A valuation. And that's it. I'll open it up for questions if anybody has any in the chat. Will, you tell me if any new ones have come in, and otherwise I'll pass it back over to you.
Awesome. Thanks. And I don't see any in the chat, but do feel free to chime in there. And feel free to ping us after too. So I'll put my email in here. I have a couple more things I want to share before we go to the questions, just generally section, but I'm going to put my email in the chat, or I guess I can't put it in the chat here, but I'll send it over after, and you all can have my email if you have any questions about this, or just have any questions like generally in this space. Josh is a great resource. I can definitely help out when it comes to this stuff too. So please do utilize us and like our data that I'm going to show you as a resource as you go through granting equity, receiving your own equity, doing a company valuation. And yeah, so the next thing that I want to jump into quickly is going to be, and Josh, I'll let you be question monitor if we have any that come up in the next few minutes too. Is actually going to be some of the data that Carta has. And then this is going to be coupled with what we're going to leave you all with is kind of like an assignment. And so what I want to show you quickly is this industry data that we have. So Carta has 30,000 companies on the platform. We've aggregated and anonymized all of our data. We've made a compensation product out of it. We've also been able to siphon out a lot of the industry fundraising trends and seeing kind of what people are raising at in what industry. And so here's some data that you can see across fundraising round. So you can see a seed round here, a series A, B, right, all the way to late stage. And then you can see the industry. And so here you can see that like a biotech company for a series seed round, and this is going to tie in all the terminology that Josh just brought up. You can see that the average is going to be them raising about $2.4 million in that seed round with an average post-money valuation. So remember, that's the pre-money, what the investor assigns to the company plus the money invested is going to be $20 million. And you can see that down at the bottom here. So we're going to send this over after. I'm going to make sure that you all have this data, but this is going to be kind of the first piece of the equation on our side. You can also see kind of VC data by stage here. So this is more on the VC sides of things, like the types of rounds that are being raised, how much is being raised, and the median amount in each round. And then the last piece of data on this front is going to be fundraising dilution. And so, Jessica, this doesn't answer your question down to like the granular amount of what each like company, like founder retains in like a seed round per se, because that's going to really depend on the company. Do you have 2 founders? Do you have 2 co-founders? Or do you have 3, right? Do you have 1 or 2, right? And so like that's going to make a big difference there. That being said, what you can see are the 25th median and 75th percentile of amount of the company sold in each financing round. And so what would kind of follow intuitively is that at the earlier stage, investors who are taking a little bit bigger of a risk by investing in an early stage company, you can see in 2021 and 2020 that the median amount is going to be around that, 16 to 20, a little closer to 20%. Sold in a round. And so you would be able to calculate that into kind of your own holdings too. But you see, of course, it will lower and be a lower amount as the company's a little bit later stage, has more investors, has already diluted the cap table, and has maybe cash flow or revenue or something that's a little more tangible on paper too. So going back quickly to this is going to be the assignment that we want to just like leave for you all. So we will implore you to go take a look at this, see where your industry lands for the next fundraising round you're looking at. So if you're a seed company and you're in social media, we ask that you go check out and see what the Series A is going to look like for social media companies, and go grab, say we'll do like a fintech company, maybe we'll do like a Series Seed here. So say it's a pre-seed company. Go look at the seed round, what you're going to be raising, and so like what the industry is going to be raising, and then you can see that post money valuation there. So grab these 2 numbers, so the cash raised in the round and the post money for whatever round you're looking to raise, and just do it based on your industry here. And then we have this really cool free tool called the Safes and Notes Convertible Calculator. So this piece is relevant if you're thinking about raising a safe or a convertible note. And we can definitely get into some of the main differences. I know Josh hit on those a little bit earlier. But what you can do is actually take that round for your industry and go into this tool, and they're both free. You don't have to log in or anything like that. And then you can go into this tool. You basically build out your current ownership structure. So you set the number fully diluted, your ownership, the options remaining in the pool, what Josh talked about a little bit earlier. And then what you're able to do is go set this price round. So we'll grab the money, we'll grab the data that we had from over here. So we have the cash raised in the round and the post money valuation. And then we will put that in here. So we'll say it's like 2 million, 2.5 million, and then the pre-money, right? And then you'll set these metrics based on the data that we provide. We ask that you just go in and do this and take a look based on your ownership structure that you can put in here, and just see what this is going to trickle down to as far as dilution goes. And you can see some of these numbers here. So you can see your current ownership before the round, after you enter in this data. You can see the post-priced round ownership. And so we ask you to just go grab some of our industry data, plug your data on top of ours, and then see how it trickles down when you go do a financing round for what we see as the industry average. Of course, the industry average is just that. It's an average, it's a median, it's going to be different for each company. So take it with a grain of salt, but it's hopefully something that can be a useful tool for you all as you look into your next financing round, as you look to raise more capital. So we definitely implore you to go take a look at that. And then the next thing that we would like you to do is what Josh mentioned earlier, is we have our Equity 101 course. And Josh is actually kind of the star of this course. He runs through and does a lot of these sessions himself. And so we have 10 sessions here. Here's one that's like, what is equity? And it talks about equity ownership. A lot of the stuff that Josh actually hit on today, but each of these have little quizzes at the end of it. And so with the ones that we think would be best for you, and we'll send this like little assignment packaged after, and I'll send it over email, would be the vesting side of things. So what Josh talked about there, how to sell your shares, how equity grants are taxed, and then if you'd like, how venture capital works. And so each of these has a little quiz at the end of the section to check your knowledge on it. But we, if you are so inclined, and we would like it if you do it too, feel free to go watch these and kind of check your knowledge up first as what Josh went over today. And then it'll be quizzed on this too. So last thing before we turn it over to you all is that if you are so inclined, and no pressure at all here, to sign up for Carta, we have a free plan for companies with fewer than 25 stakeholders and less than $1 million raised. We have a kind of like a partner link. So you will have access to our free plan. And then if you decide to go to a paid plan, you get 20% off through the partnership here. So no pressure to do that at all. If you decide to, just make sure you go through the partner link so you get the best deal possible. Okay, I'm going to send over the assignment after, and then we will turn it over. I know we just have a minute left here, but I'll turn it over for questions if there are any. I don't see any in the chat now, but if there are any questions, feel free to chime in.
Thank you so much, Josh and Will, for that great session. I think we have 2 questions. So one would be, what type of equity do companies typically grant at the early stages?
Totally. Yeah, and I think Josh highlighted that a little earlier. I'll kick it back over to you on that. I think the ISO, the NSO, the RSU, the RSA, I think you're still muted, Josh.
Oh, yeah. Sorry. Can you hear me?
Yes.
All right, cool. So like the official answer that we have to give when we answer a question like this is talk to your law firm. So with that being said, I think the thing that we most commonly see is startups giving ISO shares, which is basically just a type of stock option. In its most simple form, the answer is most startups that we work with, because of their ownership structure and the type of equity that their legal team advises them to give, we see most companies give options to their employees. And the kind of options that they give are ISOs, or incentive stock options. Is that cool?
Okay. So another one would be maybe reiterating on, can you talk about some of the benefits and drawbacks of doing a convertible round, safe round, and price round for financing?
Totally. Yeah, I can hit on that to start, Josh. I think it's of course going to depend for each company, right? So each company is going to have their own way of doing things, but I think the main thing is that a convertible is technically a debt instrument, and so it could be called in potentially at one day, or called in potentially one day, versus a safe note is not debt. Right. So the safe note is a simple agreement for future equity. And so those two are convertible instruments. The note could be paid back, or may be called in to be paid back in full one day, versus the safe note would not be. But that being said, I'd say that the main difference, and Josh, feel free to chime in here too, is between the safe and the convertible note, which are converting on to the cap table later, and the price round, is that the convertible and the safe round, you're kind of punting the valuation out. It's what Josh said earlier. You're not going to be doing the valuation now. And so we're actually seeing right now in kind of this down market, this market that's slowing down, a lot more people are doing safe rounds because they want to kick that valuation down the road a little bit. So that's kind of my 2 cents on it. Josh, anything to add there?
Yeah, I'll just piggyback on what you said, Will. Like, essentially the root of the question, the way we usually frame it, is like, you have levers that you're pulling, right? Like if I do a safe round, or I do a convertible note, or I do a price round, what are the advantages of doing it that way? And what are the disadvantages? What do I gain and what do I lose from doing it either way? So I'll bucket them into 2 buckets really quick. We've got a price round, and then we've got convertible instruments, which that is both a convertible note and a safe. So with a priced round, you're giving up a certain level of control in your company. You're usually bringing on board members at that point. And so you, as the founder CEO, no longer just have carte blanche control to do whatever you want. You got to answer to your investors now. With a convertible instrument, like a safe or a convertible note, you're still gonna give up control, but for now, today, you are keeping control. So you keep decision-making power, and nobody can tell you what to do until 18 months from now, when you eventually give shares to those investors, and now they've got the control they wanted. Now, so that's what you gain by doing a convertible instrument. But what you lose by doing a convertible instrument is that a convertible instrument, just by nature, is really risky for the investor, right? The investor is giving you $1 million, and they have no control over what you do and no idea what your company is worth. So in exchange for that, the investor is going to rip your eyes out 18 months from now when you actually give them shares. Like, you're going to give them a sweet, sweet deal in 18 months, and they're going to get a lot more shares than the people who come in at the priced round stage. And it makes sense. It's a lot more risky for the investor. So you're going to have to give them a bigger percentage of your company later. But for the next 18 months, you hold on to control of your company, and you can, guide the ship how you see it. There are some other advantages and disadvantages. Let me just quickly zoom into, okay, so we've talked about priced rounds versus convertible instruments. Now let's zoom into convertible instruments and talk about safes versus convertible notes, right? Because now, like, okay, let's say you decide you want to do a convertible. Well, do I want to do a safe or do I want to do a convertible note? Will touched on the difference here. Another big difference is that when you think about a convertible note, it's kind of like taking out a loan from a bank, just like in a traditional sense. Like, the bank is giving you money, and then there will eventually come a point in the future when you have to pay back that money plus interest. So a convertible note has an expiration date and an interest rate. So today you're going to receive $1 million. 12 months from now, you're going to have to pay back $1 million and $1,200,000 worth of shares. That's kind of the way a convertible note works. With a safe, there is no interest rate. So with a safe, you're not going to, it depends on the contract that you work out, but typically with a safe, you're not going to set like a specific expiration date. You're going to set a set of conditions that need to happen in order for you to pay back the loan in shares. So instead of just 12 months from now, I'm going to pay you back with interest. Now it's like, okay, I'm going to pay you back when I raise my Series A. And that could be 2 years from now. That could be 1 year from now, et cetera. Those are like the main high level differences. But again, talk to your lawyer, because like those legal contracts get like super confusing. To have them explain it to you before you do it.
I will say, last thing to add on the safe is that, that it was created actually to be good for not that high of legal fees, right? It's really a simple agreement for future equity. They're the easiest way to raise money typically is going to be through a safe, because there's all these templated docs, and now it's become kind of like industry standard, because Y Combinator popularized their post-money safe. That's what it was called. Well, I guess it was pre-money to start, and now it's the post-money safe. And now all securities lawyers around the US know what a safe is. So regardless of if it's the best instrument or not, and we always see debate about this, so a pre-money versus a post-money safe, like which one's better, almost all lawyers are going to know what a safe template is, what the document looks like, and they're going to be able to either help you with it quickly, or you won't even need to really need them as much for it. Of course, we recommend that you do, because sometimes the terms can get a little different and more customized, but in its most honest, just templated form, it's meant to be a really straightforward agreement. And so I'd say that's one of the number one reasons people do it too. It's like, you're not going to be incurring that many legal costs like a price round you typically do.
Much more simple. Yeah.
Yep. Awesome.
All right. I don't think we have any more questions. So thank you so much again, Will and Josh, for being here and conducting a really good, interesting session with us.
All right. Thanks so much for having us on. It was great meeting you all. And I'll follow up with assignment information, and then you can all distribute that to the attendees today. But thanks so much for having us on.